Okay, let's do it. Good afternoon. Welcome to Talk Your Chart. My name is Segrera. I'm an advisor with Evensky and Katz and Coral Gables. I am joined by my good friend and colleague, Brett Horowitz. Brett, how are you?
Hey, Marcos. It has been a long week, so I think we should just get right to it.
Let's do it. It is Friday afternoon. You are standing between me and probably a glass of something. So I think last time I went first, so you can go first today. What chart do you bring to us this afternoon?
Interest rates. I'm all about interest rates because it seems to come up over and over and over again. And I think people are way too concerned about interest rates rising. But I'd say almost every conversation, there's someone worried about it because they own bonds, they own cash, they own CDs, and they say, why do I want to be in something that's going to be losing money with higher interest rates?
Okay. I mean, reasonable to be at least curious because we're 40 years of falling rates. Now we have what comes next, right? So
yeah, with the 10-year at 1.2, 1.3, whatever it is, right? It is a risk, right? It's one of the risks that are out there when you hold individual bonds or even bond funds. But the chart I want to bring up first here is a chart of the Bloomberg Barclays US Ag. So this is the biggest bond index out there.
okay.
And this chart shows the last 40 years of bond returns.
Okay.
What we're going to look at is the left-hand side, which has, out of the last 40 years, 3 losses in the index, 0.1%, 0.2%, and 0.3%.
Yes.
So when we talk about losses, these are not big losses.
Magnitude is the word, right?
Now you could take this chart and say, my gosh, well, this is great. This is 40 years of bond gains in a period of time where rates are going down because they peaked in the early 80s. They've not fallen every year since, but it's been a general trend downward since. And so the second chart I'm going to show here is a chart showing basically from the 50s to the 80s, in that 30-year period where you had rates skyrocket from like 2% to, I don't know, 15%. Bonds still made a decent return over that 30-year horizon. It wasn't what you see in this chart, a lot of double-digit returns, but it was still a solid number. So I find that investors just want to get away from bonds and think that this thing is going to lead to, a horrible situation, when in reality, the losses, if there are any, can be probably pretty modest.
Yeah, I think that's the biggest thing to point to. Rates are going to rise, right? And we don't know when, we don't know by how much, but if you look backwards, it's a descending scale as you're showing us. Looking forward, rates are going to go up. We know the inverse relationship is what makes everybody nervous. Rates go up, bond prices go down. Ouch, it hurts your bond portfolio. We saw that in the first 5 months of the year, right? So when we were looking at bond portfolios with clients, we were reporting red numbers. That's changed a little bit, but we saw pain. I think to your point, though, it's a magnified pain that the magnitude is just not going to matter because, and look, I think you're the person that says it the most in all of our client meetings. A bad day in the stock market is nothing like perhaps a bad year in the bond market, right? And I think that's the conversation.
Yeah, I make the analogy. It's like running away from a swarm of bees in order to run towards a bear, right? Like one's going to hurt and one could kill you. That's what we're talking about. But let's be clear, though, when we talk about rates rising, right, it doesn't mean that every bond all across the world, all different bond markets are rising, right? You probably still don't want to own junk bonds. You probably don't want to own long-term bonds. You probably don't want to own some foreign bonds. It doesn't mean everything's going to go up or down uniformly. But this is what we're talking about: capital preservation, safety, the stuff that we have in the portfolio and probably most clients own.
Yeah, that's fair. And I think it's also important to note the chart you're showing, which has the Barclays Ag. That's not just corporates. That's not just government bonds. It's not just XYZ. That's a spectrum across all bond markets, right? I think for us specifically, I think we'd be in a more precarious situation if we had a bunch of government bonds in our portfolio as opposed to what we actually have, which is a bunch of high quality corporate debt. Because as we always focus on real rates of return, meaning returns after you account for inflation, it's off everyone's radar because it was ages ago. But it surprised me because I really hadn't seen the chart until I think earlier this year. There was a 40-year period of time where the real rate of return of government bonds was negative from 1940 to 1979. You had a negative real rate of return in government bonds. So we're not telling everyone feel comfortable if you're sitting in a bunch of 10-year treasuries or a bunch of like one short-term treasuries. That's not going to be good for you if you're trying to protect your purchasing power. But if you own corporate bonds that pay you reasonable yields and you're assuming good credit underwriting, so these are people that are fly-by-night companies, but you're talking about the biggest, sexiest companies that are basically in the business of printing money, then yeah, you probably feel more comfortable that over time you'll be in a better place than where you started.
Well, would I not like to go back to 1980 and buy a bond paying 16% and hold it for 30 years?
I know and it's incredible. So hold on. So let's throw some stats out there that are interesting to look at. So where were rates at the end of the last two bull markets, right? And this is just assuming, let's say June 30th of this year was the end of a bull market, right? Obviously, we know it hasn't been, but let's just use that as kind of a standing point. If we go to October of 07 and we look at the federal funds rate, right? So October of 07 was the end of a bull market. The Fed funds rate was at 4 3/4. Where was it June of 21? 25 basis points, right? So that's kind of funny. And then let's rewind one more, go to the tech bubble. So March of 2000, where was the Fed funds rate? Just take a guess.
You're going to tell me wrong.
I know I am.
6%.
It was 6%.
6%.
Did you say 6?
I said 6.
Jesus Christ. You're cheating, dude. You're looking at my charts. I didn't send you my charts intentionally. You still got it right. So yeah, so just think about that, right? So end of the tech bubble, or I'm sorry, just before the tech bubble, we had a 6% Fed funds rate. And then top before the GFC, 4 3/4. And now we're looking at a quarter basis point, right? For top of that. So it's just kind of interesting to see where we've been. There's no room to go lower, but a lot of people have saying there's been no room to go lower for 7 years, right?
Well, in some European countries, you have negative rates and they actually will pay you back on your mortgage. They will pay payments to you. So heck, I'm waiting for that. Let's have my mortgage company paying me to have a mortgage.
I know. So it's to be determined, but I think I do agree with you that the worry about rates rising is probably a bit overblown from a magnitude standpoint. Right. It'll be painful over a certain amount of time, but I think the chart that we like to show is that it's kind of like a 7-year break even, right? Over time, you want rates to go up. Right now, you're getting nothing on cash.
Right.
So yeah, it's almost a welcoming opportunity to have rates going up over time.
Yeah, it'll be painful for some, but I think it's blown out of proportion. And the fact is, you don't know how it's going to turn out. No one knows. Like you said, we think it's going to go up, but when is it going to go up? And how is it going to go up? And where is it going to go up? You know, how fast? I mean, all these questions are unanswerable.
Yeah, the speed matters, right? Speed matters.
Sure.
Okay.
So what's on your mind?
Today, I'm specifically thinking about, and this is a conversation we've had with clients over the last who knows how long, because tech has been leading the way for quite some time. I'm looking at here the top 10 companies by market capitalization, how big they are, of the S&P 500.
Specifically, why do I care about that?
So I'll tell you right now, we're looking at the top 10 in 2011.
Okay.
Between 2011 and 2021, how many companies do you think fell off of the top 10 of the S&P 500?
And I have not seen this chart, so I'm going to make a wild guess.
You're on the spot.
And I guess every single time wrong when we play these games, but I'm going to keep trying. I'll go with 5.
It's not bad. It was 6.
Okay.
So 6 of these companies didn't make it, specifically Exxon, IBM, Chevron, Walmart, GE, Procter and Gamble all fell off and were basically replaced by the tech companies that we all know. Right now, what's the top 10? Apple, Microsoft, Amazon, Facebook, Google, Berkshire, Tesla, Nvidia, JP Morgan. That's what it looks like right now. So the question I'm going to ask you is, between 2021 and 10 years from now, what do you think could be the event or the series of events that causes the next 10 companies to change?
I mean, the only thing that I can think of would be regulation, because these companies are making so much money. I feel like they can practically swim in money. I watched a special on Bezos and his Blue, what was it called? Blue Origins, right? I think they said he's spending $1 billion every single year over the last 21 years. He started in 2000 to get a tiny rocket up to go into space for a couple minutes. I mean, these companies are making so much money, and every year you think they can't keep making more money, and they do.
And they do, precisely. And we're happy about it, right? Because we're happy to have 14 boxes from Amazon sitting in front of our door when we get home, right? We're happy not to pay for these things. We know now at this point why we're not paying for them, because they take our data and sell it to somebody else. But we're all happy to do that.
I guess. I mean, I would love to work with other companies and not have them take my data and get things slower potentially, but it's just so convenient. Like, where do you go now to get toys? Where do you go now to get so many different things?
We all do it. How many times have you gone to a website, found the thing that you wanted, and then gone to Amazon and searched it? Right? Yeah, guilty as charged every single time. So you hit it on the head. Regulation. They've tried and failed with a whole regulation thing. I've never completely appreciated why so much failure. Three things, three kind of headlines within this regulation thing. Why does it not work? Antitrust, which is where they're trying to take this whole big tech, you're too big, we're going to break you up. Let's use the bodies of law that have been around since literally the 1800s to break them up. Why doesn't it work? Because the main one, the Sherman Act that we all learned about at some point in time in like middle school, is basically looking at predatory pricing, which is usually I corner a market and increase prices. And what do we just talk about? Tech does the exact opposite. It drops prices, and that's what limits competition, which is crazy.
They always say, though, that there's other firms out there. They always say there's like there's other firms besides Amazon that are similar. And they always use those in examples that I've seen and say, well, you can go to this other site and get something similar. But come on, we all know everybody uses Amazon, everybody uses Google, everybody uses Apple. Like, they're really not competition.
Yeah, I think they do a good job of putting together all that. There's other competitors, and they do lip service to it. But I think because the FTC and the Department of Justice are using these bodies of the law that just don't address the issue, that's the problem. So now here's where I think something's changed. The new chair of the FTC is a woman by the name of Lina Khan. She's 32, and she actually understands what these businesses do. She's not going to.
Did she work with them? Because I never heard of her.
I never heard of her until recently. And she, by the way, she's 32 years old. She is younger than both of us, and she is the chair of the FTC. That's kind of a big deal. So congrats to her. But here's what's also interesting, which I learned from reading about Lina Khan. There's the Sherman Act, the Clayton Act, all those boring things that we won't get into. There's one I didn't know about, the Federal Trade and Commission Act, which, two legalese here. What does the FTCA, this act, try to do? It basically is going to try to get to these big tech companies by saying they're using unfair methods of competition and unfair or deceptive acts or practices in order to corner the market. That hasn't been done, to my understanding, and I think that's what Lina Khan is going to do.
Well, we'll see. Proof's in the pudding, right? I mean, seems like Europe is much better about cutting off these big tech companies and what they're doing than we are over here.
I don't disagree with you, but if I'm going to pick what might cause this to happen, what might change that top 10 in the S&P from now to 10 years from now, my vote is going to go to Lina Khan, Department of Justice, getting their stuff together and saying, Google, Facebook, Amazon, you're not being fair. And then they use that to inject some Sherman Act stuff or some Clayton Act stuff. And who knows, maybe you end up with Amazon and AWS, their Amazon Web Services, which is where all the money is, and they break those things up. Imagine that, right? That would definitely shake things up.
I mean, I think people want that. Like you said, I think we know that a lot of people in Congress are asking about that. I saw a study on CNBC a few years ago where it was like 70% of people consumers wanted there to be a limit on compensation, on how much power these companies had. Surprising from a democratic country that we have, right? We're not a socialist or communist country, but I think people are fed up with billionaires making even more money and leaving the rest of us behind.
Yeah. And for me, man, do I need this to happen and want this to happen? I don't have a horse in the race. What I do think makes a material difference in innovation is these big companies that are retaining thousands of super duper intelligent data scientists and engineers that are incredibly smart and intelligent, and they basically pay them millions of dollars to work at Google or Apple or Facebook as engineers doing a whole lot of nothing, right? And those people are doing that. They're making a logical economic decision for themselves and their family. But if these tech companies couldn't do that, these could be people starting the next startup that disrupts this company, that takes us from living only on planet Earth to living on the moon or whatever it might be. And so I think that's, for innovation, I think that's a good thing.
Sure. Well, I think there'll be a point in time, though, if they don't do this breakup, that you and I will be getting paychecks from Amazon because they'll be our employer, right? I mean, that's where it's going at this point. We'll all be owned by Amazon.
It could be, man. It could be. I guess maybe you and I can open up the first office on the moon.
Well, they're saying, and Bezos is saying that in 3 years, he's going to rocket ship that's 5 times as big as what just went up into space that will make it to the moon. And they're going to start testing that out.
Yeah, he's talking a lot. It was fun to see those 2 billionaire dudes get up to space.
Yeah.
Anyways, my friend, BH, always a pleasure.
See ya.